Crack the code. From recession to rich season. Catch the full video for tips on using recession to your advantage and unlocking your path to a richer you. Did you ever want to do something when things didn't go your way? Like when playing a game or facing a challenge? Did you think about getting stronger with your money during uncertain times? Did you ever wish you can make the best out of tough times to have more money? If you said yes to these, then you're in for a treat with this video. Today, we're talking about what Warren Buffett thinks about times when the economy's not doing so great. But before we dive in, we want to say a big thank you for sticking with us. Your support really means a lot. Can we ask for a bit more? Could you tap that like button? Write a comment, and maybe share this video. And hey, if you haven't yet, consider subscribing to Luxo-Life for more cool videos like this. Thanks a bunch. Alright, let's start by getting to know the amazing Warren Buffett a little better. Imagine having a really smart friend who's great with money and knows all the tricks to make it grow. Well, that's Warren Buffett. He's like the guru of investing, who is basically about making your money work hard for you while you just chill. And you know what? He's not some fancy suit-wearing guy who talks in confusing terms. Nope, he's more like that friendly neighbor who talks to you about money over BBQ. So think of mixing your favorite teacher's wisdom with your coolest buddy's chill vibes. That's Warren Buffett for you. He's awesome at explaining money stuff without making it all complicated, and that's what makes him really special. Now that we know who he is, get ready to dive into some of his super smart money tips. First, let's dive into a fascinating topic: how a recession can actually be a golden chance for you. You know, when the economy hits a rough patch and people start talking about hard times, it might not seem like there's much to celebrate. But hold on a sec. Warren Buffett, the money guru we just met, sees it differently. To him, a recession is like a secret door to opportunities that can make you richer. Yep, you heard that right. Now let's check out what Buffett thinks about recessions. He's like the wise money uncle who knows that when the economy takes a dip, it's like a big sale happening in the stock market. Imagine walking into a store and finding all the cool stuff you want at super low prices. Well, in a recession, stocks, those little pieces of companies you can buy, become cheaper too. Buffett says it's like getting a discount on stocks, just like you'd get a deal on your favorite snacks. It's kind of like a magic trick that Buffett knows. While everyone else might be worried and hiding their wallets, he's out there shopping for stocks. And guess what? He's not just shopping for today, he's shopping for the future. He's like the smart shopper who knows that if you buy quality stuff on sale, it's going to be worth even more when things pick up again. So when everyone's talking about tough times and belts getting tighter, Buffett is looking at the bigger picture. He's saying, hey, this is my chance to buy into great companies at a fraction of the cost. It's like being the first in line for a mega sale, but instead of clothes or gadgets, you're picking up pieces of businesses. That's how Buffett sees recessions, as an opportunity to build wealth while everyone else is waiting on the sidelines. Now let's get into what they call the net savers benefit. Sounds fancy, right? But don't worry, we'll break it down in simple terms. So picture this: a recession hits, things are a bit tight, and people start saving more than they spend. That's where the net savers step in. They're like the clever folks who manage to tuck away more money than they're dishing out. And guess what? Recessions play right into their hands. In times when everyone's pulling back, net savers are in a prime position. It's like they've been putting away acorns for the winter, while others were spending like there's no tomorrow. And when the economy takes a dip, these acorns start growing bigger. How? Well, imagine you're at a yard sale, and suddenly, the prices drop on everything you want. Net savers have more cash saved up, and now they can use that stash to snag some incredible deals, like scooping up shares of companies at rock-bottom prices. Think of it like this: when the stock market is having a bit of a sale, net savers can swoop in and get more for their money. It's like scoring extra toppings on your pizza without paying extra. And here's where the beauty comes in. The net savers aren't just buying and waiting around. Nope, they're playing the long game. They're steadily investing during the recession, snapping up more and more shares in those companies they believe will bounce back. It's like building a tower of building blocks, one by one, while others might be watching. Now here's where it gets exciting. Imagine the economy starts picking up, and the stock prices begin to rise again. Remember all those extra shares the net savers got during the recession? Well, those extra shares translate into a bigger piece of the pie. It's like having more slices of a delicious cake. And when the cake gets bigger and better, the net savers are sitting pretty, enjoying the rewards of their smart moves during tough times. So while others might be catching up, net savers are already ahead in the game, thanks to their strategic approach to investing during a recession. Alright, let's switch gears and dive into something called rational stock buying. It's not as complicated as it sounds, promise. Imagine walking into a candy store with a pocket full of change. You're not picking candies based on bravery, right? It's more about doing the math to get the most bang for your buck. Well, the same goes for buying stocks during a market downturn. Warren Buffett, who we're learning so much from, wasn't always a big-time investor. Nope, he started young and smart. He used to deliver newspapers and saved up his earnings. And guess what he did with that hard-earned money? He invested it in stocks. It's like he saw the potential for his money to grow and multiply over time. So even back then, he was all about thinking ahead and making decisions based on reason, not just luck. Now let's fast forward to today's world. Back in the day, you'd need to be a Wall Street wizard to get your hands on stocks. But thanks to the internet, things have changed big time. It's like getting a backstage pass to the stock market. You can easily buy and sell stocks online, just like you'd order your favorite snacks. This accessibility has transformed the investment game. You don't need a fancy suit or a ton of cash to get started. With just a few clicks, you can be part of the stock market action, making decisions based on your own research and understanding. So think about it like this. Rational stock buying isn't about making bold moves in the heat of the moment. It's about making calculated decisions, just like you do when picking the best candy deal in the store. Whether it's Buffett investing his newspaper money or you clicking away on your computer, it's all about being smart and rational when it comes to putting your money to work. It is now time to lend us your ears, Luxo lovers, as we're about to tackle the intriguing concept known as the do something bias. Don't let the jargon intimidate you. It's much simpler than it sounds. Ever felt that itch to take some action, any action, when things get a bit uncertain or don't go as planned? Well, that's precisely what the do something bias is all about. You can spot this bias in action in various parts of life. Think about soccer penalty kicks. Sometimes the goalie just dives in a direction, any direction, even if staying still might have been wiser. Our brain seems to believe that doing something is better than doing nothing, even when it might not be true. And guess what? This bias can heavily impact our investment decisions too. Let's break it down further. When the stock market is on the upswing, everyone's in high spirits, and that do something bias kicks in big time. It's like wanting to join the fun. The fear of missing out creeps in if you're not part of the excitement. So you might make hasty purchases, grabbing stocks simply because they're on the rise without giving it a second thought. Conversely, when the market takes a dip, anxiety can set in. Instead of calmly assessing the situation, you might rush to sell your stocks, driven by the fear that things could get even worse. It's akin to giving away your candy stash just because you heard there might be a candy shortage. Not the smartest move, right? In the realm of investing, this bias can steer us towards choices that may not be the wisest in the grand scheme of things. Similar to kicking the soccer ball without a clear plan and missing the goal, making impulsive stock decisions during market fluctuations might end up affecting your financial aspirations. But here's the silver lining. Now that you're in the know, armed with this understanding, you can step back, think it through, and make more level-headed choices. It's just like you would take a moment to strategize before that crucial soccer penalty kick. It's time for a little reminder. Instead of jumping in without thinking, being impulsive, why not take a moment and be patient? That rush to do something might feel exciting, but let's slow down and consider the big picture. Charlie Munger, a wise voice in the world of money, has some thoughts on this that are quite insightful. Munger's view on gaining from investments is like savoring a well-cooked meal instead of gobbling down fast food. He talks about the strength of being patient and having restraint. It's like he's saying, hold on a minute, don't rush into everything. This is especially important in a world where everyone seems to be in a hurry. Imagine everyone around you is in a frenzy, but Munger is the one who's calmly taking his time, making thoughtful decisions. It's like he's telling us to slow down and really think about our actions. In a world that glorifies constant movement, Munger's perspective is like a breath of fresh air, a reminder that sometimes it's better to take a step back. Now let's talk about building what's called a fortress balance sheet. It's like creating a strong financial shield that can weather any storm. Warren Buffett's strategy for this is pretty straightforward. Focus on how you manage your business and keep a healthy amount of cash on hand. Think of it like this. Imagine you're building a sandcastle by the beach. You want it to be sturdy and able to withstand any waves that come crashing in. Similarly, in the financial world, you want your balance sheet to be solid and prepared for any challenges that might arise. Buffett's company, Berkshire Hathaway, is a prime example of this approach. It's like they've built a financial fortress with strong walls and a deep moat. They hold a significant amount of cash and bonds in their arsenal. This isn't just about being cautious. It's about being ready to take advantage of opportunities that come their way, whether it's acquiring a promising business or making a strategic move. Having a robust balance sheet means you're not only prepared for tough times, but also poised to make the most of good ones. Just like a well-built sandcastle can weather both rain and shine, a well-managed balance sheet can help your financial journey stay steady, regardless of the ups and downs that might come your way. So take a page from Buffett's book. Focus on managing your resources wisely and keeping a strong financial foundation that's ready to face whatever comes next. Alright, Luxo lovers, it's that time. Let's talk about how all this wisdom from Warren Buffett can actually apply to your own financial journey. Think of it as taking these powerful ideas and tailoring them to fit your own money matters. First off, let's adapt Buffett's approach to your personal finances. It's like taking a recipe from a famous chef and making it your own by adding your favorite flavors. Just like he focuses on business management and cash reserves, you can focus on managing your own financial resources wisely. It's about looking at where your money is going and making sure it's being used in the best possible way. Now let's talk about minimizing debt and maximizing savings. It's like tidying up your financial house and making sure you're not carrying too much unnecessary baggage. Just as Buffett suggests maintaining a fortress balance sheet, you can create your own financial fortress by reducing debt and building up your savings. This not only gives you a sense of security, but also positions you well to weather any economic storms that might come your way. And speaking of storms, let's dive into the idea of creating resilience against economic downturns. Think of it as building a sturdy shelter that can withstand any weather, financial or otherwise. Following Buffett's lead, you can work on strengthening your financial foundation. This means having a safety net in place, like an emergency fund, that can help you stay afloat even if things get tough. It's like having an umbrella ready before the rain starts pouring. Lastly, let's touch on positioning for potential investment prospects. It's like having your fishing gear ready when you know the fish are biting. Just as Berkshire Hathaway keeps cash on hand for opportunities, you can position yourself to take advantage of potential investments that might come your way. This doesn't mean being impulsive, but rather being prepared and ready to make informed decisions when the time is right. Last but not the least, let's delve into a crucial aspect: strategic planning and discipline. These principles echo the core of what Warren Buffett advocates for successful investing. It's like following a roadmap that leads you towards your financial goals with precision. Emphasizing a long-term strategy is the key here. It's like planting a tree that will eventually provide shade and fruit. Just as Buffett looks at the long game in his investments, you too can focus on the big picture. It's about not getting swayed by short-term market fluctuations and keeping your eyes on the prize in the distance. This approach aligns perfectly with Warren Buffett's investment philosophy. It's like you're dancing to the same rhythm, following the same beat. Just as he seeks out solid businesses with strong fundamentals, you can seek out opportunities that fit your long-term vision. It's about being disciplined in your decisions and making choices that are aligned with your overall financial strategy. So remember, as you navigate your financial journey, strategic planning and discipline can be your guiding lights. It's like having a compass that keeps you on track, even when things around you might be chaotic. By echoing Buffett's principles and staying true to a long-term strategy, you're setting yourself up for a more secure and successful financial future. And that's all for today's video. We hope you've gained valuable insights into turning tough times into opportunities and building a stronger financial future, all thanks to Warren Buffett's wisdom. We want to express our heartfelt gratitude to our amazing Luxo lovers. Your support means the world to us. If you found this video helpful and enjoy the content, don't forget to show some love by giving us a thumbs up, dropping a comment to share your thoughts, and sharing this video with your friends and family. And if you haven't already, why not subscribe to Luxo-Life and hit that notification bell so you never miss out on upcoming content. Thanks for tuning in, and we look forward to catching you in our next video.